Okay, I think his wise will start immediately. So we are going to proceed, and as many that will join later will have to meet us halfway, and hopefully wherever they can catch up from, they catch up, and then we proceed. I don't know if that's okay by us. All right, perfect. Monday, you're welcome. Um, um, Iseko, you're welcome. As many other persons that are here, you're all welcome. Okay, let's dive in straight to the session almost immediately. Okay, you're all welcome once again, and this session is brought by this is my Binance Masterclass, understanding cryptocurrency and blockchain. So this is made possible by partnership with Binance, and it's brought to you by Binance. And this is like phase one of the class. So expected to have like two phases. So I believe that after phase one of this, after this phase, I will be launching into the next phase of this class. And but the long and short of it is that by the end of this class, we all should be able to uh, understand cryptocurrency the way it should be, the workings and the technology behind cryptocurrency as well as blockchain, and then we should be able to carry out our first trade, and then just understand the workings of cryptocurrency. Um, so that's the whole idea behind this class, because we understand that the level of acceptance and adoption of cryptocurrency in this part of the world, as Africa, for example, is not what it should be. So that necessitated this class. So we are trying to reach out to more and more persons, get them to understand that with cryptocurrency you can, as well as blockchain, you can scale up your businesses, reach out to more persons all over the world, and carry out safer and more secure transactions. So that's the motive behind the whole of this class. So let's uh, let's dive in. Okay, okay. Like I said before, this is titled "The Basics of Crypto Trading." I'm going to learn how we could set a trade on a platform known as Binance. And like I said before, Binance is the one sponsoring this. So this is made possible by Binance Academy. And a quick introduction of myself. My name is Marvelous. I'm a crypto and a blockchain enthusiast. I've been in this space for the past 2 years, to be precise. I think I started 2018. Yes. My personal mission is to accelerate Africa's transmission transition into a sustainable and developed economy by leveraging on innovations. And such innovation is, for example, the blockchain and the crypto, which already is here to stay. So, and then I have a background in computer science, and then learning is like a hobby to me. Like I love trying out new things aside the normal computer science programming and all whatnot. I'm intrigued by new things and new ideas. So I'm passionate about cryptocurrency education and driving adoption of blockchain and crypto assets in Africa. So long and short of it is that by the end of this event, we all should know what Bitcoin and cryptocurrency is, how blockchain works, and practically we should be able to, to, to understand how we could uh, buy and sell cryptocurrency. Okay. Like I said before, Binance. This is brought to you by Binance. This is made available by Binance. Then what is Binance? Binance is one of the world leading crypto exchange exchange platform in the world. and then it is currently number one in terms of volume. Binance is the world leading blockchain and cryptocurrency infrastructure provider with a financial product side suite that includes the largest digital asset by volume. So, with Binance, you could trade your cryptocurrency and then access other cryptocurrency products. Now, the beauty of using Binance is that Binance gives you a variable, a multiple options like the user face, the user interface is sleek, and then yes, the user experience. In fact, um, most times it's almost seamless transiting from the desktop view to the mobile view. Yes, almost seamless. Like if you've never used the mobile view before, you've never used the desktop view before, you're coming from the mobile view, um, you could just easily access everything, almost everything you need to access almost immediately. Um, that's what it is with Binance. Okay, so let's dive into trading. Done with the introduction. Looking at trading. What is trading? In the commonest of senses, or in the commonest of terms, if you like, um, trading is basically any activity that involves exchange of value. For example, um, let's say I'm in need of a cup of ice cream, and then I go to the seller of that cup of ice cream, and the seller is in need of say 500 naira from me. So we have to exchange values at that point in time. I say, okay, I will need your cup of ice cream. You have my 500 naira. So what happens is that I give you my 500 naira and I collect the cup of ice cream. At that point in time, we've done exchange. We've exchanged items. We've exchanged values. So we can say that trade has taken place. Trade has taken place then. Um, So we can say trade has taken place. So this principle cuts across every facet of finance and business. Basically, any activity that involves you exchanging something in return for something, you give something to get something. That's called trading. So, like in cryptocurrency, you can say, okay, I want to trade. Let's say, let's say I want to trade. Say I want to trade. Um, um, So I want to trade, for example, um, BTC against Ethereum. Fine, you have BTC. You want to buy Ethereum. So when you carry out such an activity, such a transaction, you're able to sell your BTC to get Ethereum. That is what that's a trade. So that's what a trade is. Um, we're going to be looking at the next slide would be okay, getting to understand how Binance interface looks like. Now, if you access Binance using your desktop or your mobile view, they are, like I said before, they are almost the same. The disparities are not much, almost the same. So if you the first time you accessed it, you use your what do they call it now? The desktop, fine. If you are transiting to your mobile, still very beautiful. The interfaces are similar and easy and straightforward. Now, if you're looking, I don't know if you can see this the slide on the screen. Um, to the left, you have things like chart and graphs, right? That's the chart area that tells you the price movement of a particular commodity that you've selected. The price movement of a particular commodity, say Bitcoin, say Ethereum, say Ripple, say EOS, whatever commodity, whatever asset this point in time now. That tells you the price movement. That's what the chart does. Now in the chart area, that's where you are able to carry out your with the chart. You're able to carry out your technical analysis. You study the candlestick chart, as well as the moving average, the Bollinger Bands, and all whatnot. So that's the chart area. And then after the chart area, um, by the top and the right, just immediately after the chart area by the top, you have the market pairs. This is where you select the market pair you want to trade. Now, if you go there, you see a whole lot of pairs. You can see pairs like BTC against Ethereum, that is BTC slash ETH. You can see BTC against Ripple, that's BTC slash XRP. You can also have things like BTC against Theta USDT. You could also even have like in Nigeria now, like trading crypto against fiat. You could have BTC against Naira. You could have Ethereum against Naira. You could as well have Ripple against Naira and Tron against Naira. So that place where you have such combinations of pairs is what is where we call the market pairs. The market pairs, and then under the market pairs we have the order book, the order box. Now this is where you buy or you sell. You place your order. Now placing of order could be in three dimensions or even more, but for the scope of this, we are going to be looking at the three basic ways in which you could place orders. You could place orders using um, your limit order. You could place order using the stop market, and then you could place order using the market. Okay. Now, now, that's the order box where you could either buy or you do what you sell, and then right at the top end you see the order book, the amount of asset that is being sold or bought at a given time frame. That's where you have your order book. Okay, the next slide: market pairs and other types. What is a market and a market pair? When we talk about a specific market, we mean the place where buyers and sellers come together to trade a certain asset. We can talk about a market pair. Okay, but when we talk about the market pair, we are talking about if we buy something, what are we paying with? And if we sell something, what are we getting? Straightforward. Just like we know the general market or the conventional market, a place where buyers and sellers meet to transact. That's the market. Like in this place now, it can be an exchange. For example, Binance. Binance is called a market where buyers and sellers meet and then they carry out exchange, they carry out trading. That's a market. And now, but a market pair is if I want to get Binance, for example, Binance coin. Now I want to get Binance coin. What am I paying with? I want to get Ethereum. What am I paying with? So if I'm getting Ethereum and I'm paying with, let's say, USDT dollar token, um, that will now form a pair. That would be like, okay, USDT slash what Ethereum. That means I'm I'm paying with Ethereum and I'm getting USDT. I hope that's straightforward enough. Let's take the market pair BTC versus ZAR. That's to say the South African currency. The same could go for BTC slash Naira and other currencies. Okay, so I have to pay with Naira to buy what my Bitcoin. If I have BTC slash, now always note that the first um, um, the first assets is normally something slash something. For example, BTC slash Ethereum. So like the very first asset is the one you are getting, and the second one is the one you are using to get that. So if I have like BTC slash Naira, I'm using Naira to get what BTC, and if I sell BTC, I am getting Naira. That's what it means. I sell BTC, I get Naira. I buy BTC, I need Naira. So that's basically what market pairs and market is all about. So now let's look at order type. Like I said before, we have many types of orders you could place on the markets, but we're looking at three order types. We're looking at the limit order, the the market order, and the stop loss order. I don't know if the screen is clear enough. Is it clear enough? Can somebody just indicate to me? Hello? Hello? Is what? Okay, it's small. Okay, let me see if I can make it a bit bigger. Thank you very much for the feedback. Um, Just hold on a bit. Wow, still not giving me what I want. Um. Okay, I think we'll still work with that. Trying to get the screen to get wider than these. It's not doesn't seem to work. So I think we'll proceed with this. Okay. Meanwhile, if there's any question or any thought or any query, you could easily drop it at the chat box, and then we'll address them later. Um, let's look at the limit order. The limit order. What's the limit order? Um, the limit order is an order to buy or sell an asset at a specific price or better. The idea behind the limit order is um, you set a price for which you want to buy a particular asset. Like in this case, it may be say Bitcoin, maybe say Ethereum, but you just set a price. Let's assume the current price of Bitcoin is say, for example, $11,000, and as a buyer, you want to maximize profit, so you wouldn't want to buy at $11,000. You want to buy at a price lower than $11,000. So you expect you're believing that the price will fall to say 10,800. So you can say okay, when the price falls to 10,800, you can say okay, when the price falls to 10,800, then buy um, buy such and such what assets. Buy such and such assets. Now, what you've successfully done is you set a limit order. Now, what it will do is it will wait for the price of that asset to fall. For example, like in our case study here, Bitcoin, it will wait for the price of that Bitcoin to fall to say 10,800 rather, or a better price than that. So, if, for example, you know the way the price of asset fluctuates, it can move from um, say 11,000 to 10,900, 10,850, and it doesn't get to 10,800, and from 850 it goes to 700. Now, 700 is better than 800. So, since it gets to 700, it will pick that of 700. But if it gets to 800, fine. But if it does not get to 800, that order will not be filled. So that's limit order. It looks for a particular price which is set by the buyer or the seller, indicate depending on the action that is being carried now. Just for the best price possible, and then does what? Execute that order at that particular price. So if it falls and get to 10,800, fine, it fills the order. But if it keeps 10,800, let's say it falls from 11,000 to 10,900, 10 from 10,900 it falls further to 10,850, 820. It doesn't get to 800. From 820 it goes to like say 10,750 or 7 something. Fine. 7 something is a better price than 8, so it will still pick that of 7 something and fills your order for you. That is what stop. That's the limit order. Now the next order there is the next order there the next order there is the market order. What the market order does what the market order does is the market order picks the market order executes your order, your trade with the best immediate market price. Yeah. So if you are executing a trade using the market order, That trade is executed almost immediately. Almost immediately, it is executed almost immediately with the best immediate market price. So that's a market order. Now, the other one is the stop loss order. The stop loss order. Now, here is where everything gets interesting. The stop loss order, with the stop loss order, you're able to with a stop loss order, you are able to set certain range for your order. For example, you are expecting, let's say you want to sell your crypto, your Bitcoin, and the price at which the current price of Bitcoin is 11,000, for example, and then you want to wait for it to rise. You're expecting it to rise to like say 11.5, and then you sell. But there are indications that it may still drop from say 11,000 to like 10,008 or any region lower than that. So what do? You you set a stop loss order. So what a stop loss does is that it executes um, an order for you even before your main order is reached, so as to minimize your loss. So you can say, okay, um, this asset is going to drop, it's going to rise, but there is this belief, there's this indication that it might likely drop, instead of increasing. It might go the other way around. So what do? You set a stop loss order. You could say, okay, um, I'm expecting this. You could say, okay, I'm expecting the price to rise. I'm expecting the price to rise, but what if it drops? Now, if it drops, you're in losses, right? Good. So, like a check, you say, okay, if this thing drops, if the opposite condition happens before my market condition is met, what should happen? Sell before I lose almost everything I have. So that's what stop loss does. It manages your losses. So rather than allowing the opposite market trend or the opposite market condition to catch up with you and your asset, you set a stop loss. So a very practical example could be the price of Bitcoin is 11,000, for example. Not actually 11,000 now. I'm giving an instance now. Price of Bitcoin is 11,000, and you're expecting it to rise to like say 11.5. I said okay, but you set a stop loss and say, if this thing does not rise from 11,000 to 11.5, and instead it starts falling to say 10,000 something, when it gets to 10,950, sell. So I manage my what? My losses. That way, if the price of Bitcoin falls from say 11,000 to say 10,500, you won't lose much because you set your stop loss at 10,950. So you would only be losing say $50. I hope I'm making sense. So that's the usefulness of what? Stop loss. Good. Um Now this is where it gets interesting, and then we are now entering the technical versus the fundamental analysis. Now um this is these are two major tools, two major analytical tools used by traders and asset managers to assess the market trend and decide which commodity to buy or sell, decide when to buy and when to sell, decide when not to buy and when not to sell. So these two key tools, the technical analysis and the fundamental analysis, they are what is being leveraged on to carry out cryptocurrency trading. Not only in cryptocurrency, even in forex and in stocks, these two are also employed. So, straight up, what is fundamental analysis? A friend of mine will always say fundamental analysis means analysis using news like news surrounding a particular or what or commodity, a particular asset. Now, if for example you a very practical example, now you are trading on forex, and as a forex trader, it is you get the information that like what is currently happening in Nigeria now. There is pandemonium, there is civil unrest. It is expected that the naira will drop because economic activities are almost crumbled. They are almost crippled to a standstill. So when you get such information, I say, oh, let me trade against the naira, and I'm expecting the naira to drop against the dollar. Are you getting me? What you are doing is called fundamental analysis. Are you following? So looking at the underlying factors that can affect an asset's value, that's fundamental analysis. For Bitcoin, these include the number of addresses, hash rates, and trading volumes. So when you are carrying out your analysis based on some factors that can affect a particular asset, like I've just given you a very typical example now, the Naira, for example, can be affected with civil unrest, um, economic crisis, good. And okay, you look at it and you say, I think the Naira will drop against the dollar. And then you you decide to trade against the naira. What you've done now is called fundamental analysis. What you've done is called fundamental analysis. Now let's look at the next one. That's called um, technical analysis. Technical analysis, just like the name implies, is a bit more technical, uh, a bit more in depth than fundamental analysis. Why fundamental analysis could be on the surface, technical analysis involves a bit more time and more study, calculations, and real-time analysis and study of charts and graphs. Good. So, technical analysis involves using history and pattern trends that emerge to make prediction about the market. So you study the trend, the history, and then the current trend, and then with that you're able to predict. Okay, you say um, a particular asset, for example, you say Bitcoin, for example, in the last 24 hours, it has been overbought, and there is possibly going to be a correction, a pullback, reversal. And then you say, okay, because of this, I think this is a very good point. This is a very good time to take a position for Bitcoin. And then you get in. What you are doing at that point in time is called technical what? Analysis. These are the charts we always see with multiple lines. By the end of this lesson, you'll be a technical analysis user. So basically, what technical analysis does, it studying of charts, movements of trends, and all those graphical representations of the data of a particular asset. So that's what technical analysis does. Um, there are tools used for technical analysis. We have the candlestick chart, the trend line, support and resistance, and then we have common technical tools, common technical analysis indicators, and how to use them. And we are going to be looking at the relative strength index, the moving average, and then the Bollinger Bands. So these are the major tools used for technical analysis. Your candlestick, your trend line, and then your relative strength index, your moving averages, as well as your Bollinger Bands. Sounds a little bit confusing, right? Don't worry, we are going to brush them down right away. Now, a candlestick, just like we all know, a candle has the base and a wick. Yes, the base and a wick. Now, that's a common candle. Now, if you've seen most chart, that's how they look like. But in this case, the wick is at the top and at the bottom, not just only at the top like in normal candle. We have the wick at the top and the wick at the bottom, and then we have the solid base around the candle. Good. So that's a candlestick chart. A candlestick chart is made up of four data points: the open, the high, the low, and the close. And that's why it is also referred to as OHLC. O standing for open, H high, L low, and then C close. Now, the open and the close are the first and last recorded price for a given time frame. That indicates the open tells you um, the opening price for a particular time frame. Let's assume we are looking at a 24-hour trading volume of a particular asset. Now, the opening price, let's assume for the 24 hours, Bitcoin started at say um, $11,000, and then it rose from $11,000 after 24 hours interval to say it closed at the end of 24 hours at 11,200. Now, you realize that that is the what? The open and the close. But in between the open and the close, in between that 24 hours period, something is likely to happen. It is likely that um, the price of that asset would have fallen below the open price or above the open price or risen above the open price. Now, when it falls below the open price, it falls to a particular point that we call the low. the low. First, a particular point that we call the low. The low. So the lowest price at which it falls is the one we call the low. That's the candle wick, the bottom candle wick, the low. Now, the top candle wick gives us the highest price for that 24 hours trading period. So if, say, in the 24 hours trading period, Bitcoin opened at $11,000, and then within that 24 hours it rose to, say, the highest it rose was 11,500, and the lowest it fall was 10,800. Then the low will be 10.8, the high will be what? Your guess is as good as mine. 11,500. Good. So that is what the highs and the low. Candlestick chart analysis is one of the most common ways to look at Bitcoin market using technical what analysis. In fact, the candlestick is not, it's not like a new thing. No, it's not like a new phenomenon. It's been there over ages. As early as the 17th century, it was developed by the Japanese, but it has been refined in the early 20th century by trading pioneers such as Charles Dow. So, one major way of understanding price movement and analysis using technical analysis is the use of candlestick charts. Now, the next one is the trend lines. The trend lines. What is a trend line? Wow. A trend line is a line drawn over highs or under lows to show the price direction. Over highs or under lows to show price what direction. Remember, like what I said, high being the what the highest price it traded for that particular period, low being the lowest price it traded, different from the open and the close. The open and the close means the price with which it started. Let's assume that trade started 12 a.m. in the morning and it ending 12 p.m. Sorry, it's ending 11:55 p.m. in the night. Good. 11:59 rather p.m. in the night. Good. Now, that price at which it started with at 12 a.m. is the opening price. That price at which it is closing at 11:59 is the what? Is the closing price. So regardless of the highs and the low, we take these 2 points, we call it the open and the close. Now the highest between those two intervals becomes the high. The lowest between those two intervals becomes the what? The low. So a trend line is drawn over highs, that's to say, on just touching the highs on top of it, and then below the lows to indicate the price direction. They show support and what resistance. Now, when you draw it above the highs, it is indicating a resistant level. When you draw it below the lows, it is indicating what? A support what? Level. Trend lines are widely used tools by both traders and technical analysts. They are lines that connect data points on a chart. Typically, this data is a price, but not in all cases. Some traders may also draw trend lines on technical analysis and oscillators. So there are other ways you could use trend line, not only to get data points and prices only. You could also use them as oscillators and all whatnot. So that's trend line. Now, if you look at this, let me see if I can. Now, if you look at these two trend lines we have on the screen, there's one that is ticked good and the other one is ticked bad. Now, you don't draw. Oh my God! You don't draw draw a trend line and allows it to cut across um uh how will I put it now? You don't draw a trend line. Your trend line must be touching two lows or two highs. It doesn't go in between. It doesn't cut across it. It must touch two lows or two highs. That's the right way of drawing a trend line. So you draw your trend line to touch two lows or two lights or two highs. When it's cut across, it becomes a broken trend line. So I don't want to get a broken trend line because that won't give you a perfect support level or a perfect resistant level. So, like you've heard me talk about support and resistance. What then is support, and then what is what resistance? Support and resistance are some of the most basic concepts related to trading and technical analysis. What is resistance? Resistance means a level where the price finds a ceiling. Resistance level is an area of significant supply where sellers step in and push the price down. Forget about the big grammar. What resistance tells you is the price at which sellers have overshadowed the market. So what happens? The price has no other option than to come down. It's basic, it's simple demand and supply. When there are the sellers is more than the buyers, what will happen to that product, that commodity? It is expected that that commodity will do what? Will drop in price, right? Good. That level at which sellers have supersede the number of buyers, have exceeded the number of buyers, have saturated the market. That level is called the resistant level. Are you following? So that level at which the sellers have outweighed the buyers, that level is called the resistant level. And then we have the the support level, which is the direct opposite of the resistant level. The support level means the level where the price finds a floor. In other words, the support level is an area of significant demand where buyers step in and push the price upwards. So what happens is that in support, buyers are more than sellers, so the price will have to do what? Go up. Are you following? So just like in normal conventional market, when the buyers are more than the sellers, what will happen? Normally, naturally, the price of that commodity is expected to skyrocket, is expected to shoot up. So that's what happens with um, resistance and support. So resistance, simply put, the price at which sellers are more than buyers, and as a result of that, the price of that commodity will have to fall. And then support, the level at which buyers are more than sellers, and as a result of that, the price will have to shoot up. Now, there are common technical analysis indicators, like we noted before. There's what is called the relative strength index. There's another one called the moving average, and there's another one called sorry, there's another one called the Bollinger Band. So let's look at each of them one after the other. Hope you guys are with me, right? Okay, that's good. So, like I said earlier, the the form for the attendance is already on the chat group. So, uh, in chats messages, so you can just check it out. Can I ask a question? Questions will be taken at the end of towards the end of the class. So please let's just exercise a bit more patience. So, like I said, you could fill out your details and then we can move on from there. So back to relative strength index. Now, when we're talking about relative strength index, just like the word, let's pick them one after the other. It's made up of three words: relative, strength, and then index. We're talking about index. We'll talk about a measurement scale, right? Um, more like a yardstick. Yeah, more like a yardstick, a scale, and then relative. It's not absolute. It may change, right? Good. And then strength has to do with ability, right? Good. So the relative strength index of a particular asset, a commodity, let's say Bitcoin, for example, gives us the idea if that particular asset has been overbought or oversold. Are you following? Now, the relative strength index is a momentum oscillator that shows the rate at which price changes does what happen. Now, this range. Now, this range, what this relative strength index does is that um, it gives us an idea if a particular commodity is overbought or oversold. Now, do we just look at the particular commodity and conclude that wow, this commodity is overbought? No. Or this commodity is oversold? No. There are certain indicators, there are certain levels it will have to get to, and then we arrive at a conclusion that this commodity is overbought or oversold. Now, the relative strength index ranges from two extremes, from 0 to 100. From 0 to 100. Now, When it is 70 and above, when the relative strength index of an asset, say say Bitcoin, for example, or Ethereum, or any asset at all, when the relative strength index is 70 and above, greater than 70, we say, sorry, is greater than 70, when the relative index is greater than 70, we say that what asset has been what oversold, and there's a possibility that the price will shoot down. Are you following? Where 70% and above indicates an overbought what asset. So what that happens is that when it is overbought, the price shoots. When it's overbought, what happens? There's actually there is a possibility of having what we call a correction of price. As to say, it will fall down to a certain price level again, um, before maybe it starts going up again. So that's what relative strength index does. And when it's oversold, what happens? It means that it will rise to a particular price level again before it starts falling again. So that's what the relative strength index gives us. The idea it gives us that okay, this particular asset has been overbought. It's time for it to retrace its step, like come back a bit. Now, I know some of us may be wondering, when something is bought, that means it was sold, right? Yes. But in this context, when we say something is overbought and oversold, for something to be overbought already means it's already oversold, right? You're thinking the way I'm thinking. But in this context, overbought means the price shoots up to the upper extreme above 70, and then oversold means the price shoots down to the lower extreme below 30. So these are the two conditions, or these are the two situations in which we say an asset is overbought or oversold. When the price shoots to the higher extreme, above 70, we say it is what? Overbought. But when it shoots to the lower extreme below 30, we say such asset is what? Oversold. So that's what? The relative strength index. And then the next is a moving average. Moving average. Those of us that did statistics, or that are statistician, the moving average is not a strange phenomenon to us. Moving average is a concept in statistics that is used to indicate seasonal variations. And seasonal variations have to do with, like the word entails, seasonal variations, like changes with times. So moving average is a tool for measuring price momentum. It is used to smooth out the price of data by creating a constantly updated average price. So what moving average does is that um, it gives us a constantly updated average price of a particular asset. Are you following? So as time goes on, the price of a particular asset has to be updated because transactions are being carried out. So moving average helps us to be updated with that price. So that's what moving average does. It gives us a constantly updated average price of what? A commodity. Now there are different types of moving average. I think basic there are three major types of moving average. We have the simple moving average, the weighted moving average, and the exponential moving average. But for the context of this, for the scope of this class, um, we just looked at moving average the way they are as technical analysis tools that are used to smooth out the price of a particular asset by constantly updating us with their what? Their price average. And then we have the next one is that's the Bollinger Band. The Bollinger Band. The Bollinger Band was invented by John Bollinger, named after the inventor John Bollinger. And the beauty of the Bollinger Band is that it works almost like a rubber band. Okay, you hear the word band. So it has the ability to compress, sorry, to expand or contract. So a Bollinger Band gives us the amount, it gives us the standard deviation of a particular asset from its moving average. From its moving average. Covet tell am say she never suggest to enter now. So from its moving average. So what happens with a Bollinger Band is that it's made up of three lines, and then the three lines are the one in the middle is always the moving average. The one in the middle is the moving average. So that's the one in the middle is the moving average. It tells you um, um, like the mean price of that asset for that point in time, and the line at the top tells you how far from the how far from the average that price has gone. The one at the bottom tells you how far from the average it has fallen. Are you following? So Bollinger Bands, the indicator made up of three lines or bands, a simple moving average in the middle, an upper and lower band. These bands are then overlaid on the charts along with the price action. The idea is that volatility increases or decreases. As volatility increases or decreases, the distance between these bands changes, that's expand or contract. That's to say, as the price shoots up or downwards, depending on the action of that price or the price action at a particular time, as it shoots upward or downward, the band expands or contracts. So that's the workings of the Bollinger Bands. Now, next we are looking at is scalping. Scalping. What is scalping? Scalping is a trading style that specializes in profiting off of small price changes. Let's assume you're a scalper, like you're a trader that scalps. What you want to do is you look at your graph, you look at your charts, and then, for example, you are looking at BTC, and then at 11, I like using that benchmark $11,000. BTC is currently at $11,000 and it's fluctuating from $11,000. It's going to 11,100 and it's falling back to 11,000. 11,100 is falling back to 11,000. So what a scalper would want to do is scalper want to take an entry position at say 11,000 within that shortest time period, matter of seconds, minutes, or thereabout, and say, okay, in the next 1 minute or so, it will get to 11,000, it will fall in 11,100 and it will fall back to 11,000. So let me just, within this time interval, this shortest time interval, let me make use of this fluctuation. Let me profit from this fluctuation in time. And then you get in, and then you get out almost immediately. That is called what? Scalping. But mind you, scalping is a very dangerous, it's a very dangerous technique. Like it may sound very interesting and very promising, but it's very dangerous. Now, scalpers they accumulate profits because since the time interval is very small, the profit is very small. So what they do is they go in, they come out, they wait, they go in again, they come out, they wait, they go in, they come out. So after a long period of time, they would have accumulated smaller profit to give them larger profits. So that's what scalpers do. They make use of smaller price movement and then profit from such. So the motivation here is because smaller price movements are easily achievable. When you're scalping, is because it is easy for it is easier for Bitcoin to move from say $11,000 to 11,100 and fall back to 11,000 than it is for Bitcoin to move from 11,000 to say 11,500 and then move back to 11,000. So it's easier for it to move from 11,000 to 11,100, fall back to 11,000 and then move back to maybe 1150 thereabout than move from 11,000 to 11,500 and then fall back to 11,000. I'm not saying it's not possible, I'm not saying it's impossible. I'm saying it's difficult. It's easier for the first scenario to take place and for the second scenario to take place. Now, because of this, that is why scalpers take advantage of this slight difference in price in the shortest period of time. That's what we call what? Scalping. Now, day trading. Just like the name implies, day trading. Day trading. Um, Day trading involves it's a strategy that involves entering and exiting positions within a 24-hour period, not more than 24 hours, within a 24 hours period. So when you enter and exit a position within a 24 hours period, within a 24 hours interval of time, you are called a day trader. Cryptocurrency market, like you already know, and other market like Forex, um, they don't go on breaks, right? They don't go on breaks. But each asset has its opening period, and its closing period. The opening period becomes the beginning of that 24-hour day, and the closing period becomes the ending of that 24 hours day. So some persons start at the beginning and then stop at the end. Um, Take for example, if you have a store owner that sells maybe food provisions, and then he opens in the morning and then he closes in the night. Maybe he opens his shop by say 7 a.m. in the morning, and by 9 p.m. in the night, and by 9 p.m. in the night he's done. By 9 p.m. in the night he's done. Such an individual can be termed a day trader. Are you following? No. But uh, another trader, say for example, a hospital, whether you like it or not, the hospital can be termed a marketplace because you are exchanging, there's an exchange going on. You are giving money for services, right? Good. So, for example, an hospital that runs 24-hour services, medical care, and then maybe you go there in the night, say uh, 10 p.m. in the night, and your case is being treated as an emergency. Now, it is expected that you will pay more when you come 10 p.m. in the night than you would have paid when you come 10 a.m. in the morning, because what happened, uh, uh, you are coming at a time that is inconvenient, more like. So the hospital now is not called a day trader. The hospital may be referred to as a swinger, right? A swinger. It takes advantages of sharp increase in price over a longer period of time compared to the day trader. So that's what um, a day trader is. Now let's look at the next, swing trading. Like I earlier said, swing traders work with larger time horizons. Positions are usually held anywhere from a couple of days to even a couple of months. Fittingly, the goal is to profit from large swings in price, while a day trader wants to um, take advantage of changes in price within a 24 hours period. A swinger will want to say, no, let me go longer than this, let me go further than this. I can go more than 24 hours. I want to go weeks. I want to go months. More like. So a swinger, often the goal of a swinger is to identify an asset that looks undervalued and is likely to increase in value. You look at an asset, maybe you look at a particular coin, and then you study the use case and you study the possibility of it being adopted easily in the nearest future. And you say, okay, this coin has a very good use case. This coin is a potential coin. It has good value, good use case. It is valuable, but it's currently undervalued. And then you take a position in that coin. Are you following? You take a position and you're expecting, say, okay, in a matter of months, in a matter of weeks, thereabout, there's going to be mass adoption of this coin. Let's say you got a news, fundamental analysis now. You got a news that some companies in the US or in China or in anywhere they're going into partnership with. Let's assume okay. Let me give you a practical example. Let's assume the price of say Tron is let's say 5 cents currently, and then Tron is trying to partner with an airline or a transportation company that's into airline and train stations and all whatnot. And then you say, okay, if they start doing this, that means travelers will have to pay using Tron, will have to buy tickets using Tron and all whatnot, their travel ticket, air ticket, and train ticket. You look at that and say, okay, Tron, because of this idea, because of this information I've gotten, Tron is a very potential, it's a valuable coin that's undervalued currently. And then you take a position in Tron and say, okay, by the time there is this mass adoption of Tron, I am cashing in on profit. What you are doing is called swing trading. Similarly to how it is with daily trading, many swing traders will use technical analysis. However, as their strategy plays out across a longer period of time, fundamental analysis can also be a valuable tool for swing traders. Just like I just said, he got information about Tron being adopted by a company that is into transportation, and then what you do is um what you do is you decide to take a position in Tron. Are you following? You take the position in Tron. So what happens is that you are now more like what? A swing trader. Are you following? So the advantage of swing is that it doesn't come with the adrenaline rush, the tension, the pulsative feeling of the day trading. Are you following? A day trader is likely going to have a restlessness. Maybe he expected the price of a particular commodity to go high and then it's going low. There's this restlessness in him. He wants to. He's bothered if he's looking at the chart. He's looking for fundamental analysis to know if the price will still continue going downward, if it will maintain the downward trend or it will reverse and take an upward trend. In swing, there is no adrenaline rush. You know that okay, it's definite. It's just time it will take. It's definite that this commodity, this asset will go up. So that's swing trading. And then basically that's everything we have to cover within the scope of this class. Um, I'll be attending to some questions, but before that, I'm going to carry out some practicals now. Um, I'm going to see how we could place a trade on Binance. We're going to do that right now, and then we're also going to see how we could buy and sell crypto with local currency, and then we are going to see how we could set your charts as time permits us. As time permits us. So, um, okay. So let's um let's see how we could deposit first and foremost, because for you to before you can place a trade on Binance, it's expected that you have an account with Binance. So there is a link. There's a link on the chat there, the in-message chat. There's a link there, so you could. Uh, there's a link there for you to. Yeah, that's a link for you to register on Binance, create an account, and then create your account, and then off you go. You can start trading and doing the rest of it. So, very quickly, we are going to be carrying out some practicals on Binance right away. Um, so I would like to know if there's any question. Please just write it out on the comment section. Any questions should be written out on the comment section, so we can take them as time proceeds. So any comment should be written down on the comment section so we can proceed with them. Proceed with them as time goes on. So um, what happens is now right now is that I'm going to show us how we can transfer from our wallets, from our bank accounts rather, from our bank accounts to Binance. Um, Mrs. Faith, you're welcome. And going to show us how we can transfer from our bank accounts to Binance, and then how we can convert, um, how we could use that money that's been transferred to our bank account, from our bank account rather, to trade on Binance. So um, I'm just going to go to my Binance app. Okay, so okay, so okay, I'm gonna share my screen right away so you could see what I'm doing. Um, okay, so perfect. My screen is shared, so I'm going to go to my Binance app. So um, this is the Binance app. Uh, Now, if you look at the bottom, we have the home, the market, the trade, the futures, and the wallet. So these are the various menu options you could select, and then work with, and then you can carry out various actions with your Binance. So we want to deposit, so we go to our wallet, and then at the top of it you see overview, spot, margin, futures. If you move this way, you see P2P, that's peer-to-peer savings pool. So I'm just going to go to sports. That's the simplest wallet you can have. So when you go to sport, you see the asset listed. So for a new user, you've not gotten any asset. So um, most likely the asset will just be listed in alphabetical order, and the values on the right hand corner that's shown as in asterisks. Don't worry, I just had to make them show that way. As shown in asterisks, would probably be zero because there is no asset in your account. So all we want to do is we want to deposit. So now we are depositing. We have to choose what are we depositing. Are we depositing crypto or fiat? Now, fiat is more like a currency backed by government, right? A currency backed by government, that's fiat. So examples of fiat could be Nigerian naira, Canadian dollar, US dollar, Ghanaian cedis, and the rest of them. So we are not depositing crypto, we are depositing fiat. So I select on the fiat tab, and then I have the Australian dollar, Brazilian real, euro, Great Britain pound, Indonesian rupiah, Kazakhstan tenge, Nigerian naira. My interest is in depositing Nigerian naira. So I'll click on naira and watch it loads. So while that is loading, uh, as some of us that have yet to fill the attendance form, please let's endeavor to do that. And then some of us that are yet to create accounts, the link is there. You can use the link, create a new account, and then the link is don't worry. With my link, you get 5% discount on your first deposit. Okay. Now, we want to deposit naira. So Binance charges a, a fixed fee of 150 naira for any amount of bank transfer, depending on your level of verification. So some persons, I think mine is about 8 million. That's my maximum that I can deposit. So even if I'm depositing 8 million naira, I'm being charged 150 naira. That's if I'm doing bank transfer. But if I'm doing card transfer, if I'm transferring with card, buying with card, that's my MasterCard or my Visa card, or any other card as the case may be, I'm being charged 1.4%. So it's easier calculating 1.4% of 8 million. You know how much it will be. So it's better I go with the bank transfer, and then I'm being charged just 150 naira. So I select bank transfer, which is recommended. Um, let's say I want to deposit 5,000 naira. Now the fee is 150 naira. I'm getting 4,850 naira. So I have to click continue. Continue. So a pop-up will come up, and I'm asked to pay 5,000 into this account number, bank, Wema Bank. So what I have to do is I'll copy this, and then um I'll go to my mobile app, Access Bank. Okay, so I'll have to log into my Access Bank. uh, Sign in. So sign in with my fingerprint. Okay, so sign with my fingerprint. So for security reasons, I'm just gonna stop sharing screen at the moment. Stop sharing screen. Perfect. Okay, so come back, continue, and then Okay. So I want to transfer to other banks instantly. Select bank, Wema Bank, Wema. I'll put the account number. Sorry. Put in the account number. Binance Holding. Proceed. No. So 5,000 was what I wanted to transfer. Okay. Okay. So yeah, confirm. So the network is a bit slow. So um, oh wow. Now I'm gonna go back to sharing my screen. Transaction is successful. So I'm gonna go back to sharing my screen. So um, go back to my Binance. I have made this payment. Uh, so I have made this payment. So what will happen is I'm just going to exit this since I've made the payment. I'm going to exit this and then go back to my balance. I should refresh. Perfect. So now I was having, okay, what I was having was zero point 0.5 naira. So and I transferred 5 naira. So I'm just gonna hold on for some say 2 or 3 minutes, refresh my wallet, go back and check. It's not there yet. Okay, should be up anytime. Should be up anytime from now. Okay. So while we're waiting for the money to reflect on the Binance app, let's see if there are questions. Questions. Please, can you post the link again? Uh, can we have a couple of your slide? Okay. Um, please, can you post the link again? Which of the link? Which of the link are you asking about? Um, Now, to record the class, you could use your inbuilt phone recorder. Google's Meet does not. This package of Google's Meet does not. The free package does not support recording. So, uh, if you must record with Google's Meet, I think there is a premium package that supports that functionality. So, uh, I think, well, shouldn't have taken this long. Shouldn't have taken this long. So, so don't forget to tweet about this event. Um, don't forget to tweet about the event. You could um, come in. Okay, you could as well be a tutor. Yeah, you could be a tutor by simply uh, going to. If you follow my Binance Africa on Twitter, I think there's a link there um, where you could apply to be a tutor if you want to be a tutor like I am, and then um, like to keep in touch. So social media handles are all there. Uh, Social media handles are all there, so you could follow us on Twitter, on Facebook, on Instagram at Binance Africa, hashtag my Binance class. So, and then make sure you tweet about these events, say what you've learned, tag me at Megablinks, tag at my Binance Africa, and then um, we'll get in touch with you. So, um, let me refresh. I wonder why it's taking this long. Wonder why it's taking this long. It's not supposed to take this long. I think maybe my network. So if everything works as planned, we should be able to place a trade. Like I already showed you, but my network. Okay, perfect. I think it's here now. So good. So we have 4,000.